Alright, hey guys, hope everyone is doing well. So, US CPI data just came out with softer readings, basically at disinflation. We can see the CPI month on month came in negative 0.4%, so a pretty big miss compared to the forecast. And that really tanked the markets for the dollar. And for stocks, it was amazing for stocks. It was great for metals, bad for the dollar. Two-year yield started move lower. Why is that? Well, I think for the most part, markets have been pricing in hawkishness, and so now they're reacting based off realizing that okay, we are actually getting some disinflation, which is something that we've talked about here in the channel before the CPI data came out. So this is not new news here at Entry Point. We expected that disinflation because well, one, it was going to be based off June, and what we can see is that WTI for most of June has been easing, right? So there was really no reason for oil prices to continue higher. On top of that, short end inflation swaps were at lows, and what we were essentially, I guess you can say, I wouldn't want to say, I would say forecast, but a lot of it is very internalized here at Entry Point. But I guess you can say our forecast was that markets were pricing in too hawkish of a tone on the yield market, okay? Because at the end of the day, what's causing inflation or headline inflation specifically to move higher and also kind of creep into the core side is the oil prices, right? If oil prices are high, inflation will rise. It's as simple as that, okay? And we didn't really get that in June. So therefore, we forecasted that there's a good chance that markets might be too overstretched on this hawkish repricing. Um, Specifically, FedWatch was a little bit more dovish in his tone, right? He was saying things like yields are stable, volatility is low. He wasn't really talking too much about inflation as he was talking about during the FOMC June meeting, right? And so we had that priced in. We were trading that, and that's why we took some of the great trades on Kiwi to US dollar. But now, do we feel that this current reading in the CPI data, will this continue? That's the question. We need to understand a couple of things here. What is the main thing we're facing right now in the markets? Geopolitics, right? The tension between Iran and the US has escalated. Okay, right? And so that's not new news anymore, right? The oil market reacted. We're taking out structural previous low highs. And the disinflation figure was old data, right? It's data that's already been priced in. A lot of the banks have already been sort of expecting that anyways. However, will this continue? Our forecast, well, this is just our opinion, okay? We would think that inflation will still be a problem. And some of the things that Walsh was saying was, he said, we got some work to do on inflation. Jobs are stable, so eyes are more on inflation. He also mentioned dual mandate can be single mandating. So he's saying jobs are stable, but inflation is something that they need to focus on, right? So you can already see the hawkish tone coming in from Walsh, and it's very, very different from the central bank forum. Very, very different. And he also said, mission complete is not my view after today's CPI data. I do not think that after today's CPI reports, everything is swell. Guys, this is hawkish, okay? This is a hawkish tone. And that's the reason why I personally think, if we take a look at the DXY, did we really get a strong move down? I wouldn't say so, right? I mean, if you take a look, we are still within this area of support, right? We didn't really take out these lows. Why is that, right? I believe the markets are kind of in between right now, and they're probably thinking, if this low were to go, it would make sense with the current data that we got. But it's not doing that because we have the re-escalation overhead, and this creates uncertainty in the market. I would say though that for the most part, if we take a look at the VIX, we're actually seeing some weakness on the VIX, okay? But what we can see is that when we take a look at the early parts of the war, I mean, we spiked a significant number here, right? From basically, I want to say the lows at 17-ish, 17.5 to basically as high as 35, right? With this current re-escalation plus the Strait of Hamas being blocked, we're not really even getting any kind of a move. So markets are not really hedging right now. They're not really panicked. Like I said, I think the narrative of it being old news. And if we look at the stock market, the stocks are trading based on the current disinflation, right? You can see most of the stocks from euro to the US stocks to the pound, the Kospi, the Nikkei. For today specifically, we are actually moving higher and we are green on the day. So markets are more optimistic, if you ask me. They are more optimistic of this current data. They want to buy risk assets, they want to make more money, they want to get those moves. Okay. Our take is we may feel that markets might be too optimistic. Okay. Too optimistic. We think that there's a good chance inflation will last longer as long as the escalation continues and oil stays higher. Even at these prices, these are considered high. I mean, if we take a look, we were basically at the 60 plus range and we are at 78 still, guys. If we do actually hit higher here, it will be a very, very good forecast, I guess you can say, to make the potential assumption that probably inflation will be lasting for longer. I don't think we're going to get any rate cuts. We may even get hikes this year, right? And it really comes down to the next few data. So I think the next few releases really matter a lot more than the current data that we're getting right now because it's based on old data. It's based on June. This is old news. Markets are pricing in the future, and this is probably the best time to look for potential shifts in markets. Okay, so we can see that the New Zealand dollar is pretty much the stronger reading right here. The yen is not something we focus on right now. The pound is also getting a pretty strong move that we may potentially look for longs, and the euro being pretty much one of the weakest names right now. Now the thing is, we feel that US dollar will hold higher for longer. We think metals will potentially fall within the year. All right. So a lot of the reactions from the market, even though being up today, is quite muted as a whole. So I think markets are still optimistic, obviously, but they are also cautious in a sense. Okay, so we're not saying it's happening right now, but it makes more sense that it does over time. Okay, as long as we still have escalations. Escalation is a very key thing that we want to use here. If the escalations fails, though, then that's a different situation. However, I want to bring out the Strait of Hamas data right here. What we can see is that we're at 0 million barrels per day, right? Why is that? Well, Iran actually announced today that Strait of Hamas would remain closed. Okay, this is very, very important, right? We're pretty much back to where we were in the beginning of the war. And so therefore I am looking for longs for Kiwi and the pound. But for the Kiwi, I do want to be a little bit more careful. For the most part, we've been seeing some of the greatest runs from the Kiwi side. You can see NZD CAD, we can see NZD USD. We can see NZD Swiss franc is the one that has been doing extremely well. I still think there's room for continuation, but if markets kind of shift away and start to kind of focus on escalations again, right? Because that's what markets do, right? Markets kind of look at news currently and then it becomes old news and they look at a new thing. And if we get continuous escalations again and again and again, I mean we already got the Strait of Hormuz being blocked, right? So I wouldn't be surprised if Kiwi starts to fall because it's considered a risk on asset, right? So if risk on assets start to fall, so does risk on currencies like the Kiwi and Australian dollar and things like that. The other thing is that we know that the Kiwi has or the RBNZ has actually hiked rates recently, and they're planning to hike rates again. That's what markets are saying. Well, that's kind of the take for the year, at least one more hike. So there's still, a very tightening stance from the RBNZ, which can add some strength to the Kiwi, and that's the reason why we have not really been getting the same kind of movement from the Australian side because they are, they're restrictive, but I don't think they're gonna hike rates per se because they were one of the main ones that took very preemptive measures to hike basically 3 rate hikes very early in the year, and therefore that has been really working out for the Australian side. They've been seeing some inflation easing overall while oil prices were at highs. So I think Australian isn't something that I'm looking at for longs. So Kiwi and the pound is still there. I think the pound is a great sort of middle ground in this risk off to risk on flow because it acts as a hybrid in the FX market. And if we take a look at the pound, we are getting some interesting readings here. We can see that central bank has been stance is bullish, COT level bullish, COT flow bullish, bank research bullish, fundamentals neutral, seasonality bearish, retail is also bullish as a contrarian signal. We can also see that sterling faces a paradox. Their mortgage rates and lending conditions have been sort of pricing in future hikes, which have cooled housing demand, business borrowing despite falling oil prices. The UK outside sensitivity to near-term rate expectations reflecting PMI weakness that persists despite energy price relief, such as demand is already weak enough to support disinflation towards sub 2% by H2 2027. Okay, so this in 2027. All right, so this is the next catalyst, right? So we may probably see some weakness as well in the inflation data, right? But like I said, we need to think forward looking, and forward looking is probably inflation will last a little bit longer, and the current readings that we're going to get for some of these G7 names would be old news, right? But for the most part, we're seeing a pretty decent bullish signal here. If you take a look here as well, we're seeing the pound having a bullish 5 score as well, right? So I think there's some great opportunities here for longs on the pound as well as the Kiwi. It says that the Kiwi is strictly a risk on kind of asset. So it's a risky trade. Anything that happens in straight amounts can affect the Kiwi side. And as well, like I said, once markets start to price in the stronger dollar because of them realizing that, oh, okay, oil prices are actually going to be a lot more stronger, it's going to be longer, this escalation might not happen, might not be closed down so quickly. I would say that US dollar will actually have some room, and I think that will kind of take away some of the risk on assets. And I think the pound has some good opportunities for longs. Euro has some great opportunities for shorts. You can see pretty much bearish on all fronts. Even though interestingly enough here, Euro has a bullish 5 score, but looking at the situation, I mean, if we read right here, Euro faces competing narratives, wholesale prices, disinflation, soft activity data, reduces the near-term tightening pressure. Okay, so I think overall Euro is still pretty weak. I wouldn't say it's something that I will be very confident in longing. That's why if we take a look at even Euro USD, we can see that this move is pretty muted. We're pretty much still at this range. We're not really taking out the new highs, no real follow through. If we take a look at AUD USD, take a look at NZD, even GU, we actually got way better follow throughs. So yeah, so that's what we'll focus on for now. We're going to be trading the data currently, and we're going to see how it goes. However, the moment we start to see shifts, we start to see that, okay, markets are starting to realize that inflation might be actually something that will last for a little bit longer, and they start to reprice that into the yield market, then I think we will shift our narrative to USD longs, and we're probably short anything against the US dollar. One of the main ones definitely will be Euro USD, AD USD, GUSD, NZD USD. We're probably long the USD. We're probably long USD JPY, USD Swiss franc. Yeah, so those are some of the names that we're probably looking at.